So do you remember that girlfriend or boyfriend that you had, that broke up with you and they thought, oh man, you're just a loser. You're going to turn out to be nothing. And then, you make it one day and then you get to look back and you go, I hope they see what I've accomplished. Anybody ever done that before? Yeah, girl, you broke up with me. You didn't know you'd be living on a farm with 18 chickens and 3 goats, huh? Oh my goodness. Look what you missed out on. Hey, everybody. Hope you're doing well. The market is down 0.61%. I was listening to radio yesterday. I don't know. It was ABC News or something. And they come in and they, how these guys, they'll give the Dow down 274 points. And I'm like, nobody cares. That is Joe Q public. That is so public to quote what the Dow does. And then they quoted the NASDAQ. And then they didn't even mention the S&P 500. The S&P 500 is what counts. And if you guys are ever in media, or if you're ever on CNBC, don't quote what the Dow does. Nobody cares other than the public on what the Dow does. How many stocks are in the Dow? Where'd Lisa go? I always pick on Lisa Benton. Where's she at? Lisa, how many stocks in the Dow? She was here a while ago, I swear. There she is. Lisa, how many stocks in the Dow? Brent, Dr. Brent, how many's in the Dow?
100?
30.
30, wow.
Nobody cares about that. And, the Dow used to mean something, but they still quote it like it still does. I don't even mention it. It's the Dow Jones Industrial Average. It's 30 stocks. Nobody cares. Everybody should care about the S&P 500. That's the 500 largest publicly traded companies in the United States of America. That's what we give a crap about. All right, Dr. Brett, I'm going to give you a chance to redeem yourself. How many stocks in the NASDAQ?
In the NASDAQ 100, is there just a little bit above 100?
There's 102. And that's only because like Google's in there twice. I mean, technically it's 100, but you got Google and you got Google. And so, yeah, people may care about that, but you care about that more than you do the Dow. So when y'all, get to be on CNBC and all that kind of stuff, y'all just, tell the people, no one cares about the Dow. All right, who has their platform available? Who's got a platform available? Who's got your platform? Anybody? Nobody. I was going to put you on CNBC again. I was going to tell you, what's the probability that Apple will be X amount by such and such? What's the probability that by May the 20th, that Apple will be above 220? Come on, Kyle, you got it.
I'm looking up. I'm trying to think what. Okay, so I go to the options. I'm on the Apple 20 May.
Mm-hmm.
You said 220.
Yeah. What's the probability? What? Let me ask. You're on CNBC, okay?
Mm-hmm.
Kyle, glad to have you here. You're an expert on Apple. Man, Apple's at 175. By the end of May, what do you think the probability that Apple will be above 220?
I think the odds are somewhere around. What would that be? 59.2%. I think. Did I look at the right number? I can't share it on the screen. I'm looking at a desktop. I went to the 20 strikes at the 220 for Apple and looked at that was the implied, hang on. That was the implied volatility. I need to find a different number here.
Yeah, what's the probability it's going to be in the money? In other words, that the price will have gone past 220.
I read a different number. Probability in the money, it says 1.38%.
Yeah, so that's what you would,
right?
Yeah, well, the probability that it would touch it,
that would touch it,
would be double that, right? So 2.76, right, percent. Let's see if that's right. Probability of touch. Probability of touch. Let's see, probability of touching is 2.82%. So I want you guys to know that, right? So someone comes into your office, hey, what do you think about Apple? I think Apple's going to go above, 200. What's the probability of that? Well, the probability of touching it by the end of May is 13.62%. Now, the probability that it closes above that would be probability of being in the money, right? Would be probability of closing above that would be 6.66%. Oh, thank goodness it changed to 6.65. Unbelievable. All right. So everybody with me there. I want you to know, right? You are market experts now. You know how to use probabilities to come up with different strategies, which is really, really, really cool. All right. One other thing I want to make y'all aware of. Now, y'all cringed like I did at the James Cordier video, right? That just, anyone who would like to tell me their thoughts about watching that? Anybody want to be vocal with me?
It was very uncomfortable. I didn't feel it was an apology at all.
Yeah.
It was horrible.
It's horrible, especially with him wearing his Rolex watch, oh man, come on, man.
I looked him up after watching that video, and as of right now, he's never filed bankruptcy. He's not lost any money, so it appears he was not personally invested in his own fund.
Right. So let's talk about a hedge fund just for a second. I want to make sure y'all know. Now, most of y'all will never be in this arena, okay? Most of y'all will never run a hedge fund. Now, for those of you who are going to be CFPs and financial planners, you're not going to be a part of a hedge fund anyway. So those of you who are already in the financial planning arena, who deal with your company or your employer manages money, tell me how you do that. Who's here that already does that? I know we got somebody in here that does. Evan, do you do that?
I'm sure I don't.
No, you don't. Okay, I was thinking so you're never going to go, you're going, yeah, I'm sorry.
I do it currently.
Okay, Brad. So Brad, talk to us.
I do
about it.
too.
Okay, Christiana does too. So Brad, you go first, and Christiana, y'all tell me how y'all work this out.
Well, when we work for a company, we have a lot of restrictions and you have a lot of compliance issues, and you're limited to a set number of products or mutual funds that they allow you to invest in. It's more of a suitability type investment instead of fiduciary type investment. So everything's pretty much laid out for you, and we are basically a problem solver to match suitability with the right product for them. That's basically what we do. Then we can explain, other benefits about investing in Roth and traditional IRAs and what rollovers are and tax advantage means and things like that. But we can't go in separate into hedge funds, or we can't do, where I work, I can't do individual stocks.
And Brad, the clients that you have, their funds are not commingled together with everyone else's, right? I mean, everyone has their own account. How's that set up?
Everybody has their own account.
Right. Everyone has their own account. Now, are you allowed to trade or make decisions in that account, or do they do it? How does that work?
Well, we have zero discretionary authority, so it's all non-discretionary is what we have.
Okay. Christiana, tell me about how it works where you're at.
So it's a similar situation. However, in some cases, you do have discretionary over your client's accounts. But the difference, the main difference is with the compliance piece of it is gruesome. Gruesome in the fact that it doesn't allow you to do much of anything that could be nefarious to a client's account. I'll get flagged on a LinkedIn post. So imagine if I would have done what this guy did within the client's account, or even if a client is heavily concentrated in a particular stock, you constantly get emails and letters and stuff telling you how to unwind in the position. They give you resources in order to do that. So in some cases you are fiduciary. I mean, in all cases you should be a fiduciary, but in a lot of cases that the accounts are managed by you, or you can have a third party manager that manages your accounts for you.
And each client, you're going over their individual risk profile, right?
Right. Yeah. So everybody's not lumped into one case where you're aggressive or anything like that. The moment you become a client, everybody has to have their own risk profile, and their risk profile is notated on the client's account. So even if I decided to buy like a 1,000 shares of Apple in somebody's account, if that particular account is labeled as conservative and they need income immediately, I would get flagged for that trade prior to actually implementing that trade into the market.
Okay, that's great. That's exactly what I wanted to hear. Brad, Christiana, thank you so much. So in the financial advisor space, things are highly regulated. She says she would get flagged if she went and did something in an account that was labeled as conservative. The individual accounts are all segregated. They're not pooled into one fund. And we're looking at the individual client's risk profile to make sure that we set them up, with investments that fit their risk profile. So we're tailoring the investments to the individual client, okay, which is great. I'm not throwing off on that at all. Now, why is Dr. Bob not a CFP, and why will I not become a CFP? Does anyone know why? Other than maybe I'm not bright enough to pass the test.
You don't want to be responsible for other people's decisions?
I don't care what your risk profile is, right? I'm over here in the wild, wild west. So here's what I do. It's totally different. I create a fund. I create an investment strategy, right? Here's what we do. Here's what I do. And then I go, if you want to go with me, come on in, right? We're the wild, wild west over here, baby. Bobby comes up with an investment fund. Here's what our fund does. If that suits you, hop on in, baby. Let's make some money. If it doesn't suit you, don't come in. So that's what I do. I'm over here. So my funds are commingled into my hedge fund. So we are all in the same pool. We all swimming in the same pool. So I may own, 50% of my hedge fund, and my investors may own another 50%, but I'm making the decisions. Now, if you don't like it, well, you can get out. Now, you may be locked up for a year. You may not can get out for a year. So it's kind of the wild, wild west with a hedge fund. We run a hedge fund, and I simply come to an investor and I say, here's what I'm doing. Here's why I think it will work. Do you trust me as a money manager? Here's my track record. We'd love to have you hop in with me. So I'm invested in with my client's money, which apparently James Cordier was not, right? He was not in there. So, he didn't lose his money. I'm in there with these people. I come up with our own risk management. I don't look at my investor and say, is this a good fit for you? They need to say, do you want to go along on the ride with me? So it's a little different. Now, interesting question. If you're a CFP, a certified financial planner, can you commingle your money into accounts with your clients?
You're not supposed to.
Yeah, Christian, I think that's the correct answer, that you're not supposed to, right? So you'll be flagged and do all kinds of, so Dr. Bob don't want to become a CFP because I'm a co-mingler. I'm over here in the wild, wild west. We don't have nearly the regulations. I don't care about my investors' individual risk profiles. Are you conservative? Are you this? I don't care. Here's what I say. This is what we are doing. Do you want to come to the wild, wild west and be a part? When you're a financial advisor, a financial planner, you got to look at the individual, give something that's tailored for them. And then as Christiana said, if you do something that is against their risk profile, then you get flagged, blah, blah, blah. So this is not for me. So I understand that this is for a lot of you. So I'm not throwing off on that. I'm just telling you why I don't do it. And I don't want to do that because I'm in the wild, wild west. I come up with a strategy, we trade a strategy, and we go in it together. If you don't like it, you can get out. But I don't care what your individual risk parameters are. Now, because of that, there are limitations on who I can let into my fund, you know, and when, if you ever do set up your own fund, the attorneys and the accountants you work with can explain all that to you. I think I can only have 35 non-accredited investors in my fund. So if I wanted my mama in the fund, right, then I can get mama in the fund. She can be one of my 35, or I can get my sister, or I can get my aunt or uncle to come in on the fund. But other than that, then there are income limitations to who comes in. You got to have income over like $300,000. You got to have a net worth of over, you know, so many $1 million. So there's all kind of rules and regulations. I'll let my attorneys and accountants deal with that stuff to make sure that we're compliant. But really, it's the wild, wild west, right? I do kind of what I want to do. Here's what my investment thesis is, and you could hop on or hop off. So I just wanted to let you know that what James Courtier did is not something that you guys will be doing, right? Where you're in a fund and everybody's money is pooled into this one thing that they could potentially lose it all. Most of you are going to be over here, right? You're going to be dealing with individual clients, setting their investments up in their individual accounts and helping them to manage those accounts. Any questions on that at all? I just want to make sure that y'all kind of knew that from watching that video. All right. Now, let's talk about your final exam. So your final exam should take you about an hour, okay? Your final exam is going to be to come up with your own investment plan. There's really only one rule. I want you to put a lot of thought and work into it, but it should be yours. It should be personal. And the only rule is I want it on one page. So I don't ask y'all to do anything that I don't do, right? So when we're doing readings and all that kind of stuff, I do the readings along with you, even though I've already read stuff. So I read, I do everything pretty much that you guys do. So I did my own investment plan. I did it yesterday and it took me about an hour. Okay, so I'm going to show you my investment plan. So I want something for you to have to put on your refrigerator, to put it on your bathroom mirror, to take a picture of it and keep it on your phone. I want it to kind of be visible for you. It's not for anyone else's eyes other than mine and yours, right? So let me show you the one that I came up with. And I'm simple, right? Simple, simple, simple. So I used Canva. Has anyone ever used Canva? It's free. And you guys it's got all kind of stuff. So they had this little thing here and I just kind of said, hey, I'll take that and then I'll make it into my own investment plan. So I kind of used a little graphic. So this is Bobby's investment plan. Okay, this is my investment plan. This is kind of what I used over the course of my career. And I did this yesterday, like in an hour. So first of all, I talked about my philosophy. My philosophy is, hey, I'm a buy and holder. And I do that in low cost index funds, right? So that's my investment philosophy. What is your investment philosophy? What is your investment philosophy? What do you believe? I want to know what you would believe. You know, I believe that I'm going to buy 27 different stocks. I'm going to blah, 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 whatever your philosophy is. It's your philosophy, right? I want to know your philosophy. Then I want to know, what is your risk tolerance? Bobby Gaines fears nothing. I fear no man. I fear one woman. She lives with me. It scares me to death sometimes. That's Miss Beth, right? Other than that, I fear nothing. By the way, this morning, y'all know I've been going to the gym, and I said, Beth, where's the towel and washcloth? So she got out of the bed, get the towel and washcloth, and then I go, Beth, do I have a pair of socks? I couldn't find any socks. She goes, you are a man child. And woo, she was all in a tizzy today. Man child. She's living with a man child. But anyway, other than Beth, I fear nothing. Right. So basically, I then said, hey, I'm going to write out my complete philosophy, buy and hold, low cost index funds. And then I wanted one little term down here to just kind of say, what is it? My philosophy, long term, risk tolerance, full throttle. Right. So you see where Dr. Bob was at. I fear nothing. So, you know, just write it in English. You know, I fear nothing. Risk tolerance, asset allocation. Here's what I did, y'all. I did 100% C fund in my thrift savings plan. That's what I did. S&P 500, baby. So I said, okay, what's the one term that I wanted to know about my asset allocation? S&P 500. That's how I did it. I did it before I even knew Warren Buffett was doing it. I just knew, hey, I needed to be in the stocks. All right, then I want to know about your contributions. How are you going to contribution? So what I did is I did a payroll deduction every 2 weeks into my thrift savings plan, right? I did 10% of my gross salary. The government matched me 100% on up to 3%, and I got 50% match on the next 2%. Then I put additional 5% into that. Remember, what was the kind of thing I told you how to build wealth? Give away 10%. Man, I mean, be a contributor to the world and your community. Make a difference. Give money to your church, give money to the ball teams, give money to the rec department. You know, you be a wheeler and dealer in your community with whatever you have. 10%. Give away 10%. Help somebody. Then save 10%. Right? Save 10% for the rainy days and for the transmission going out, for all that stuff. Save some money and then invest 10%. That's exactly what I did. 10% gross salary. Got a great match on my thrift savings plan with the government. Okay. Rebalance and review. Well, I didn't have to rebalance. Why? Because I was 100% in the S&P 500. Ain't no rebalancing. I mean, it is what it is. And I would review it annually. You get an annual statement, you kind of look at it. So my contribution, the one word that came to my mind was automatic. Automatic. Because once you start having it taken out of your payroll or out of your bank account, you don't ever miss it. And then you start getting raises and you don't even think about it, because if you're donating or giving, contributing a percentage of your salary and your salary goes up over time, boom, it automatically increases and you never miss the money. You never miss it. So I would review it annually. So my thing was annually, right? So put the year on there. So you can say, okay, this is this year, and then update it next year. Have things change. You know, you should update this probably once a year when you're looking at your investment account. So 2022, right? What was the account that I used? So you may be using a Roth IRA or whatever, or you can make one of these for each one of your accounts. You can put them all on one page. You know, what account did I use? Thrift savings plan. What was my objective? Well, my objective a long time ago used to be to retire at, 65, because that's when I thought everybody retired. But then because I was doing all this kind of stuff, I was able to retire at 51. So I'm retired, other than teaching this class. So if you want to talk about specific numbers, what was your beginning balance of the year? What is your biweekly contribution? What is your employer match per payroll? How many years do you have until retirement? Put that on there. Not that I have 18 years till around retirement. And your projected balance. And there's all kind of calculators online that you could run these numbers. I've never been one, and I'm not going to spend a lot of time. You'll have retirement classes, right? You'll have retirement classes in this program that will help you to know how much money you need to accumulate, blah, blah, blah. This is not what this class is about. This is about investing. How am I going to make the money? You can cover all that in your retirement class. So how much do you need? But come up with an objective. And maybe your objective is, hey, I need $400,000 to buy a house. So I've just got a regular margin account and I'm going to trade that to get, 400,000. So maybe this doesn't have to be your retirement plan. It can be your, plan for, whatever you're trying to accumulate or the objective that you're trying to do. All right. So all of this. Now, here's what I thought I would do. I thought that I would give y'all this and let y'all, just change your stuff, but that'd be too easy, wouldn't it? Y'all y'all come in here. You can use the same thing. You can go in here, the popular timeline infographic, change it to yourself, or you can use this or that. Or maybe you're a Word person. You can use a Word document. Maybe you don't need pretty colors to print out in color and to hang on your refrigerator. But I thought, I don't know. It just seems like it'd be too easy if I just gave you this, right? I want you to do a little work. I want you to change this thing up. Make it your own. It doesn't have to be this. It doesn't have to be these 5 things. I just want it to be simple. Oh my gosh. What have we talked about so much in investments? We as financial advisors and planners and hedge fund, we try to make stuff complicated when it's so simple. It's really simple. Simple thing is find something that you want to invest in, right? I recommend the market. Put it in the market and go with it, baby. Now, if you want bond allocations or you want the Ray Dalio all-weather fund where you've got all kinds of diversification, even though you're going to underperform the market, then that's fine if you want that diversification. The key is find something, stick with it, automatically contribute, look at it occasionally, rebalance if you must and when, and let it ride, baby. Go with it. Review it once a year and walk away. This stuff is not rocket science. And unfortunately, in the United States, we make this rocket science so that people get out of school and they don't have any idea what to do with their money. And it's not complicated. So you guys, we've got 18 of you in here now. You 18, promise me that you're not going to make this crap complicated with your clients, with your family and friends. Hey, mama, here's what you need to do, mama. Mama, you need to put your money in the market. Because of your age, we're going to get you a little bit of bond exposure and you're going to ride it, mama. Now, when we went to mama's financial advisor, I probably told y'all this story. I said, here's what we want to do. We want to basically do the SP 500 in a low cost fund and get her a little bond exposure, and that's it. And we're going to move her out of this. Do you know what he said to me? He said, but I don't make any commission on that. I was so offended. Oh my God, this is my mama who birthed me from her loins, who spit me out, and I had a cheeseburger in one hand, a flashlight in the other. I was ready to take on the world, right? And you're telling my mama that she's got to be in some other high cost investment because you get paid on that, but you don't make any money on the other. He did not have my mama's interest at heart. That's my mama. Y'all know how it is with your mama. Don't nobody mess with mama. You don't mess with my mama. So I didn't come across the desk and choke him, but I felt like, I said, dude, this is my mama. I don't care about your, pocketbook. You're supposed to be here helping my mama. So we fired that dude. So, I want you to be genuinely concerned about those around you. Now, do I want you to make money? Yes, I want you to make money. So maybe you're a fee-only advisor. So you're charging somebody $50 to tell them they should be in the S&P 500. Whatever. I want you to get paid. But I want you to make sure that you don't overly complicate it for these people just so that you can get paid. Please don't do that. Never leave this class and be that person. Putting and trying to make it complicated, sound complicated, just so we can increase our fees. Oh, it kills me. It's so simple, y'all. If you're 22 years old, put your money in the market and let her fly. Now, if you want to do a little bit toward the 10-year millionaire and put some in TQQ or UPRO, a little bit of that, don't put all your eggs in that basket, but you want some fun money. You do want some fun money, y'all. You want to sometimes trade Apple, or sometimes you want to trade a little options account, or you want to do that. But the simple fact is this: if for our younger clients, put it in the market and roll, baby. There's nothing better. Nothing better. I heard Sean Hannity yesterday. He goes, I don't invest in the stock market. I only invest in real estate. And I thought, dude, what are you thinking? Real estate. By the way, when Sean Hannity was in Atlanta, it was so funny. Some of the people used to talk about him. He didn't even leave a tip for somebody that had, I forget, but anyway, they said he was incredibly cheap. So I don't want to talk about Sean Hannity in such a bad light, but he doesn't put money in the market, apparently. The market's where the action is. And you can invest in real estate. You want real estate? I told you why I got out of it. I'm lazy. I like sitting behind a screen. I don't like dealing with unhappy tenants. I don't like, laying sheetrock like I did in that one house that we did. I don't want to do any of that. So I'm just lazy. I like sitting behind a screen, watching my little investments, doing my little trades, and just letting it grow, baby. Just letting it grow. All right, who's got questions? Who's got questions on your assignment?
Hey, Bobby, can we do it if we're in the process of applying what we've learned? Can we give you this is what we want to be, even if we're not completely there yet, if we're trying to get there?
Give me an example, Brent. What are you talking about?
So I've got some stuff from before that I don't want to be invested in the long term, but I'm not going to wind it down like at probably by the end of the semester. But I
Yeah.
want to move it over to like an index 500 fund from
Yeah.
something a little more complicated.
Yeah, yeah,
Okay.
just, yeah. I mean, this should be yours, right? Dr. Brent, you make this yours, say, maybe your philosophy is, hey, I am moving from a philosophy of being in something, and now I'm going to a low-cost index fund. So that's your philosophy. And so maybe you're putting something in here that your action or asset allocation is to transfer from that into this, you see. So yeah, make it yours. And y'all know how I am. I want this to be yours. I want it to be simple. I want it to be something that you can follow, something that you will do. Because I genuinely care about y'all. Here's my goal for y'all is that y'all are super successful with this, regardless of how you work with your clients or the people that you're going to work with. You yourself need to be set at some point in life. And it's just a matter of you just going in and doing it regularly and dollar cost averaging in and just, letting time work. Now, some of you are my age or older. So, maybe you're not as risk tolerant as I am, and that's fine. Scale it down. But should you have more than 2 or 3 things in your investments? I don't think so. Now, if you are my age or older and you want to do the all-weather portfolio, that's great. You can have, I'm not going to get mad at you for having 6 or 8 different things in there. If that gives you safety and you feel that diversification is necessary for your portfolio, that's fine. If you're 22 years old, S&P 500, that's 500 companies. Well, Bobby, you need bonds. And no, you don't. Not when you're 22 years old. I'm sorry, you just don't. Well, Bobby, you need international exposure. No, you don't. Okay, now we can debate this. Coca-Cola is in the S&P 500, right? Do they not sell Coke all over the world? Yes, they do. Apple's in the S&P 500. Do they not sell Apple products all over the world? Yes, they do. You're plenty diversified, but if you've got to have international, get some international. I got no problem with it. I'm not going to fuss at you. I'm just saying, don't overcomplicate it. If you have 10 different things in your account, in your investment account, you are way too diversified. That's my opinion. That's my bias. So some of you were not excited about I won't say who, were not excited about your retirement class. I got that. And that's why I hope y'all appreciate this. We don't do the read a book, take a test, read a book, take a test. That's a bunch of garbage. I just don't like that. Okay. Yeah, T, what do you want me to repeat? What do you want me to repeat? You lost your connection. The thing is, I just think that if you've got 20 different things in your investment account, you got too much. I just don't.
You said 20? I said, I missed that part. Just last couple of sentences. That's it.
Yeah, if you've got, I think an investment account with 2 or 3 asset classes is plenty. 1 to 3. If you're getting 5 and 10 and 20, I mean, you're just going to be. And that's my bias. And it's okay if you disagree with me. Y'all realize that, right? It's just I'm telling you what I think. So if you put 40 in yours, that's fine. Are you going to underperform the market? Yeah, you really are. So keep it simple. Keep it simple. And I wish they keep it simple. Can you imagine if we taught this in high schools? Can you imagine if, and hopefully some of you will, you got teenagers, you got kids coming up, and you just teach them, look, little Bobby, little Susie, you just need to consistently put money into the market, keep your fees low, monitor it so often, and just do it so that you never miss the money. Can you imagine? Let's dream for a little bit. And y'all know I hate government forcing people to do anything, right? I hate that. Can you imagine if the 7.65% of our salary that is taken out for Social Security, okay, was not put into a trust fund. And then the 7.65% that the government matches and puts in that trust fund. Yeah. Can you imagine if they put the, what's 7.65% times 2? 7.6, 14, 15.3%. Can you imagine if all 15.3% of every one of our checks that they took out of our Social Security was put into the S&P 500? Every American. Can you imagine the wealth that would have been created in this country? Can you imagine little Bobby working at Fireworks City when I was 15 years old, getting Social Security taken out of my check at 15 years old and I'm 51 days. Can you imagine if they had taken out my 7.65% and put that match into the S&P 500, what my Social Security account would be worth today? Can you imagine? I believe the children is our future. Treat them well, let them lead the way. Oh my gosh, I'm getting happy, y'all. Can you imagine? Can you imagine? Now, let's go to the high schools, let's go to the middle schools, and let's tell these kids, hey, when you get a job, put your money into the all market fund. That's fine. If that more than the SP 500 or the SP 500, and let it run, baby. But Bobby, what if Coke goes out of business? They'll be replaced by another company that's going to be making profits. We got to follow the money in the country, y'all. We got to follow the money. So, you know, it doesn't matter that I think Tesla is an environmentally horrible company. It doesn't matter that that's my fault, that, you know, they're strip mining the land and paying the Taliban for the resources to make batteries, and that then they're using so much coal power to charge those batteries. It's horrible for the environment. The public thinks that Tesla's a good company. Okay, well, then Tesla must be in the S&P 500, which they are. So if people wake up and go, oh my gosh, we're using coal to charge the cars, I don't like y'all anymore, and Tesla falls out, we don't care because somebody else will take their place. I like that. The index cleanses itself. It's really cool, y'all. It's really cool. This stuff is not complicated. And I don't want y'all to overcomplicate. Don't want you to overcomplicate. How's everybody feeling? Because you know you're going to get 100 on this assignment. Just put a little work into it. Put a little work into it. Yeah, the easiest thing I could have y'all to do is to read some boring textbook and to, you know, come up with all this garbage that you don't need. And we don't want y'all to have that. Evan's feeling good. Evan's feeling good. Kyle, how you feeling?
I'm feeling great. I actually started the wheel route a few days ago, so
Oh, awesome.
it's kind of interesting.
It's fun, isn't it? It's fun. And, you know,
Yeah,
Kyle, don't put your whole thing in it, but have a little fun with it. You know, we all need fun money to kind of keep us occupied. And that's why in this class, most of your ratings have been on the slow and the, you know, the methodical, the growth, the simple, keeping it simple. But the options has just been a little icing on the cake, right? You know, do a little bit of that. Do a little bit of the 10-year millionaire, you know, do $50 a month in TQQ, you know, have a little fun.
Yeah, I'm with Kyle. I started a wheel of my own with like my actual cash account. Sold a couple puts. You know, I've got an opportunity if I get put shares to let me see exactly what I'd have to buy in at, but I've got 617 and the strike is 28.75. I've got a 916 with a $36 strike, and then I've got a 120 2023 $17.50 strike.
I may cry.
So and there's a way that if you calculate, you know, if you look at like how long you had your capital tied up, you know, to you know, cash support the put that you sold, you can back into like what the rate of return is on the amount of capital that you had tied up, and you know the profit that you get from the premium. And you know, everything I've got here is about an 18%, 19% return on my money for like the number of days that I'm holding, or that I've sold the option till expiry date. So I mean, that's better than a savings account right there if you look at it like that. And if you like the stock, then what's the difference?
And exactly, if it blows past your strike and you get assigned, you bought the stock at a discount.
Well, and at a price that you were ready to buy it at. You knew that you liked it at that price, or you never would have sold the put, right?
It's all about cost basis reduction. That's what you've done on a stock that you otherwise would have bought. You've reduced your cost basis. It's just beautiful. Oh my gosh, it's just beautiful. And it makes me almost cry, Zach and Kyle, to hear y'all, talking and stuff that you probably wouldn't have,
Nope.
thought about before.
I don't know if I'll ever buy an individual stock again. I think that every time I get into an individual stock, it's going to be because I sold a put in the first place. And like I dictated the price and got a premium for it on my way in.
Yeah, that's just beautiful.
So if you get put the stock, would you then immediately turn around and sell the shares? I'm just curious.
Would I immediately turn around and sell them? Probably not. Especially if I get put and then the price goes down even farther, because then I just, exacerbate a loss. But I mean, no, I probably.
Zach, tell her what you would do.
Sell calls, right?
You sell covered calls.
Yeah.
Yeah, I think strictly speaking, the only way you really lose money on the wheel is when the covered. So let's say you did a sign and then you sell covered calls. It's when the calls, maybe the 20 delta call, that strike price is below what you bought the asset for when you were assigned to put. I think that's kind of where you end up losing your money.
Yeah.
Right.
Yeah.
But you can get around that by dictating what you sell the call for, right?
Yeah, but it might be if the underlying falls far enough, it might be that the price that you want to sell a call at is only a 5 delta put, and you're not bringing in much money, or a 5 delta call.
Right.
So
what I would say is, if you don't want to take assignment and your strike is tested, Zach, I apologize for my dog show. I would roll it out in time, right, to give you more time to be right and collect an additional credit.
Right.
And you may be able to roll it out in time and down in price so that you're getting in a safer position, right? So you're lowering your strike and you're increasing time and you're still taking that credit.
Okay. Yeah, I haven't really got my head around rolling options yet.
All it is, Zach, is closing your current position and reestablishing your position so that the net effect is that you take in additional credit, additional premium. Hold on a second.
Okay.
Let me call that dog. Come here, Roxy, come here. What is wrong
what
with you?
platform are you using for your wheel route?
I'm using Thinkorswim.
Beth says she probably needs to put more into her investment plan than Wordle. Yeah, exactly, right? But you don't have to, the thing is, the great part is you don't have to sit in front of your screen, the whole time, doing this stuff. It's, Now, let me show you something else. Zach, real quick. So, we're really loving the 1-1-1 trade, right?
Mm-hmm.
So here's my 1-1-1 trade, y'all, in the market. This is in the micro E-minis, /MES. So you see, here's the current price of the micros, which is the same price as the E-minis, right? The big product, it's just 1/10 the size, even though it's quoted the same. Roxy, why are you barking? I'm sorry, y'all. My wife left there somewhere and I have no idea. The kids are on spring break. It's a crazy day. So here's where the price is now. So this line here is the T0 line. When I say T0, that means today, right? So here's where we are today. If the market goes down at expiration, I make a lot more money, right? Here's the T0 line as well. But here's what happens as time goes on. We put these on, and watch what happens as we go out in time. You're going to see the T0 line, which is today, you're gonna see it go up. So each day that passes, if the market goes down, to 41.35, I make more and more money. So watch this line. Everybody watch this little orange line go up, 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 up. See that? So I'm going out in time. Now I'm to the 13th. Now watch this. I go to the 14th, 15th, 16th. It just gets stronger and stronger. So that if the market goes down into this area, that we're making money. Oh no, my kids are back. So the more money we make when the market goes down. So let me show you another thing. Zach, what stock is that you're wheeling in?
It's TQQQ.
Okay, so let's show you something else, okay? So what if you did a 111 in the TQQQ? So here's TQQQ. Let's say that you go, I like going closest to 60 days without going over. And so you do a long put vertical. And let's say you move that down to about the 30 delta, so 30, 39, and you go maybe, I'm just trying here. Let's say you go, make that $1. So you're going to pay $1 for that. It's a 4 wide spread. This is a put debit spread. What does that look like? So let's look what a put debit spread looks like. Put debit spread looks like this. So if you stay here, you're going to lose the money that you paid for the spread, which would be $102, right? You paid $1.02 times 100 means $102. So your max loss is $102. Your max profit is made if you go into this area here, into this tent. So you got to go down below 51 1/4 to get this area here to where you make the 297. So now watch this. What if we add, we're doing a 111. So
that's like you're buying a put and selling a put at the same time and kind of hedging them.
Yeah, this is a
Use them
put.
to hedge each other.
Yeah, this is a put debit spread. So
Okay.
it's a bearish play. But now watch this. So you're spending $104 for this. So now what if you sold something, a couple of puts down here at the 17 delta for $1.05, but sold 2 of those? So, let's see. If I wanted you,
So like less premium, but like more certainty that they're going to be in the money for you as the seller, or not in the money, but out of the money for the buyer.
Yeah, so let's look at that. Let's look at this one only and making that 2. Let's just see what this looks like. So that you could do the entire trade for $1.13 credit, right? So you're getting a credit. So let's look at what the entire thing looks like. Now this is kind of cool. So if the market goes up, you keep the $113 credit, right? See this? Profit at expiration. Doesn't matter if TQQ goes to the moon. So if TQQQ goes down, then you've got this nice little tent right here. Now, again, as if it goes down too soon, the T0 line, which is today's line, you're losing $261, right? But if TQQ kind of slowly goes into this trap as expiration gets in closer, then you could make $514. And where's you put here? Oh,
That's kind of like you're giving up the premium or you're giving up the wins on the buying the put and you're cashing in on the 2 sells.
yeah, because the put debit spread makes money if the market goes down. So you're getting this nice little tent area here because of the put debit spread. Now, the problem is if you sold this at $1.05 times 2 and it goes past this, then you would have to take assignment of 200 shares, right?
Right.
So, but there's all different kind of ways to do it. So what if you move this up? Say if you move the 52 closer to the money. I mean, look at this, y'all. You can just play with this stuff, right? So you go, 54 there. I mean, you can move this thing to make all kinds of different, I mean, look at that. Isn't that crazy? All the different kind of things that you can do with this to make different kind of profit tents. So play with it, in the paper account, play with these things and have a lot of fun with it so that you can figure out, hey, look, now I can make $319. I've moved my short put all the way down here. But just all the different ways you can do it. But now this would be a debit trade. So I don't like paying for a trade. I like doing an entire trade as as a credit. But there's all different kind of things. I mean, the world is open to y'all. I mean, now, one thing that we've not showed you, and let me show you this on the Tastyworks platform. Let me just show you different kind of trades. So you guys we've talked about a strangle, right? Everybody knows what a strangle is, where you sell a naked call above and sell the put below, right? So you're strangling the stock. But look, there's all different kind of things that you can do here. You can do a short strangle, right, where you're selling a strangle. You can do a short straddle. We'll talk about that later. But look, let me show you this. A short iron condor. Let's see what a short iron condor is. Let me show you what an iron condor is. An iron condor is selling a put spread and at the same time selling a call spread above. So it's like a strangle, but it's defined risk. So what does this look like? Let me show you this. This is what this looks like. Let's move it out here. Yeah. So here it is. This is an iron condor. And so you can move your strikes. You can do different things with it, right? But an iron condor basically says, if you don't think that a stock is going to move that much. Now, I never do an iron condor in TQQQ because it's a big mover. But if you didn't think the stock was going to move too much, you could sell this, right? The max loss here is $8. Max profit is $42. But it's only got a 10% probability of profit, right? But this is an iron condor where you're selling a put, selling a call, but you're defining your risk by buying a call above and buying a put below. Hey, hold on a second. Let me yell at my kids 1 second, okay? Sorry, y'all, spring break. I had to yell at them. So that's an iron condor. So it's a defined risk trade. So there's all different kind of things that you could do. I mean, you move your strikes around, you know, do different things.
It looks like Tastyworks lets you play with the strategy a little bit easier than Thinkorswim does.
Yeah, it's easier to visualize, right? So y'all come in here, open your account at Tastyworks. You don't have to fund it, just open an account so that you can come in here and play with this thing. So let's say you wanted to go a short straddle. What's a short straddle? A short straddle is basically selling a put and a call at the same strike. That's basically what a straddle is. So what does it look like? It looks like this. If you don't think the price is going to move much, then you know, that's a good thing. Now, if you want to do a long strangle, let's do what a long strangle. It's just the opposite. You're buying a put and buying a call at the same strike, so that you believe that there's going to be a big move. And so if you get a big move, right? Big move means you make big money to the downside. If you think it's going to go big to the upside, you know, you make big money over here. So it's all different kind of things. So check out some of these different strategies, right? So you can either do long or short. Click on this. You can do long or short and trade these up. Let's see. Short put, you know about iron condor. There's a short call, covered call, Jade lizard. Yeah. A jade lizard is basically selling a put and then selling a call spread so that you have zero risk to the upside. So, I mean, you can play with those things with jade lizards, but there's all different kind of trades, right? Ratio spreads, you know, just buying stock. You just want to buy stock, long stock. There you are, buying 100 shares. That's what the risk graph looks like. And this is why, you know, you and I, hopefully I've converted you to not a fundamental trading and not to technical trading, but to quantitative trading, so that we know that if you buy a stock, you have a 50% probability of it going up. You have a 50% probability of it going down. This is the risk profile. And so what you and I do, we're able to increase our probabilities of success by doing certain things like a short put. That gives us an 83% probability of success. Yeah. But we limit our upside. You have limited upside. So you don't have the unlimited upside of buying stock, but at the same time, instead of a 50-50 chance of you making money, you got an 83% probability of making money. That's why I say, and continue to say, quants rule the world. If you'll use quantitative analysis, you'll use statistics, you use the Black-Scholes model that basically prices all this thing, you can make money pretty regularly on a regular basis. I think it was Mel who's been selling options in the paper account. Mel said, is it this easy? And I don't want you to think that it's easy. It's not easy. Okay, it's not easy. It's tough. But you know, you put some of these strategies in place, we can consistently do pretty well. Just takes a matter of you know, playing
It's
with
probably
it.
one of those things that's easy until it's not.
It's easy until it's not, right? Until the whole world crashes and everything, you know, starts going down, then that's when you might
Yeah.
have some problem. And that's why we put on things like hedges for black swans and different things like that. But at this point, what we're doing in this course, we're trying to keep your investments real simple. And I've just taught you options just as a little flair. I don't want you to necessarily do it on everything that you're doing, but for a portion of your portfolio or your accounts, yeah, have some fun with it, you know, especially if you were going to buy a stock anyway, or buy SPY, you know, trade an option instead. Increase your probability of profit and collect you some money. And if you are assigned to buy those shares, sell a covered call against it. Just keep willing it and reducing the cost basis. It's really a beautiful thing. It really is. And I hope you have enjoyed the process as we're kind of winding down. Now I got a few more things that we'll throw at you. We threw an iron condor at you today. I just want you to know and to play with some of these different things. Ratio spreads, there's calendar spreads, butterflies. Most of these you really don't need, but every now and then they're kind of cool. I like the 1-1-1 trade. The 1-1-1 is really cool because, as you can see, let me show it to you. I do it on the futures, and it gives you this nice little profit hump to the downside. Everybody says, I don't want the market to go down, right? Well, I kind of don't mind if it does, up to a certain point where losses could come in, but you know, I think everything's pretty good. Now I use other things. You know, I tell you, I don't use a lot of technical analysis, but sometimes I use a little. One of the things that I do like is looking at SPY on a linear regression channel, right? Because it kind of gives me, it's really cool to see. Why is it not changing? Change it. It's kind of cool to see the market basically being constrained by a linear regression channel. What is going on with my little chart? Well, you can see it here. This is SPX, same as SPY, basically. You see the channel is downward leaning, right? So which kind of tells me we're in a bearish sentiment at the moment. And it's amazing how often, you know, price is contained within this channel. It gets to the top of it and it's almost like, hey, wait a minute, I need to get back in, you know, and it may test, and it could go out and change the channel altogether. But if I'm looking now, I'm kind of like, you know, we're kind of in a bearish pattern. It's just very easy to see. And this is at TradingView. You guys can set up a free account at TradingView. I pay for an account. I don't know why. I don't think I use anything different than what you get on the free one. So everybody sees that, right? Linear regression. Here's the 200 daily moving average. Now it's going to cooperate. Let's see if yeah. Here's the 200 daily moving average. Here's the 50 daily moving average that you can put on there. Now this, did we talk about the death cross that the technical people talk about? This is the death cross. This is when the 50 crosses below the 200 moving average. And when, you know, and that basically just takes the average price of the last 50 days, right? And it changes every day because it uses the last 50 days price changes. This takes the price average of the last 200 days, right? And makes an average. So when the 50 crosses the 200, they're like, oh God, it's a death cross, which means we're definitely in a bear market. Well, are we? I'm not sure. But if I had to guess, we're pointing downward with linear regression. And, you know, the market will probably go this way. But I don't care where it goes. I try to do trades that are, you know, capitalize on theta, basically, the decay of theta in the account. Anyway, I'm rambling a little bit now. I just want to make sure I get you ready for your final exam. So your final exam, do this or something similar to that. Or you don't even have to have colors, but I want it something that you're going to put on your refrigerator. I want it something that you're going to use. Everybody with me? Have I shared a Keith Whitley song with y'all?